Welcome to the November version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. We've had several questions come in, and Chris will cover them over the duration of the presentation. Going forward, we'll be making our presentations more concise. If you have any questions during our presentation today, please write them in the chat, and I will ask them to Chris if they are timely. Otherwise, we will get back to you directly or address it in our next MSOM. This month's edition is titled Fall Back, Spring Ahead, where Chris will walk us through central bank policy, Q3 earnings season, and dividend-paying stocks. I'll pass things over to Chris. Take it away, Chris.
Thanks, Adam, and welcome everybody. As Adam mentioned, we are titling this month's edition Fall Back, Spring Ahead, a little bit of a play on words as the fall season was quite challenging for markets. We obviously just had a bit of a time change as well, but our outlook is now becoming rosier that we could see a bit of reprieve and a Santa Claus rally as we move forward. Here is our standard disclaimer slide. And so, as usual, inflation and the inflation story really has been driving the markets. We've seen, we had two Fed meetings, one here in Canada as well as one in the United States during the last month or so that have helped markets kind of bounce back a little bit. Jerome Powell, during his November press conference, mentioned that they are satisfied, or not satisfied, but encouraged about the signs they're seeing with inflation in the market. But a lot of it has still not been realized. A big part of the pullback, or the rise in inflation, has been elevated energy prices. That we saw that as the largest contributor in September. You can see that on the slide on the bottom right. That has now subsided slightly with the fact that oil has gone back down to the lowest levels since August. The Bank of Canada also mentioned the fact that our housing costs here continue to be elevated. That is a problem that's a little bit different in the United States. We have seen the rising housing costs in both rent and home ownership gripping the markets. One of the areas that has been a cause to inflation has been persistent wage growth. We see this both in Canada and the United States. Although the non-farm payrolls number last Friday was encouraging, was one of those type of prints where we saw revisions coming in lower. Unfortunately for the economy, it is these slowing economy signs that gives the Fed and the Bank of Canada the fuel they need to take their foot off the gas, per se, in raising rates. Tiff Macklem, our Bank of Canada governor, mentioned that as well in his press conference last month, and went into that press conference again with a bit of an encouraging, lower than expected inflation numbers coming in. But we would likely need to see a little bit more kind of pain in the economy and the labor market in particular to keep both central banks on pause, as although they didn't raise rates last cycle, they are keeping the optionality open to them to do so. We're just wrapping up earnings season in the United States and kind of preparing for it here in Canada. It was another sell the news type of quarter where whether you reported strong or weak earnings, on average, companies were down more than 1% on that reporting date. But it really was the companies that did poorly and reported negative earnings surprises that got punished. You can see that on the chart on the left side of your screen. Those companies reporting weaker than expected. EPS surprises really did come lower. Two of the most encouraging parts of this earnings season. One was we're seeing positive earnings growth for the first time in over a year on a year-over-year basis. So that was encouraging. The S&P 500 is now we're expected to make the highest EPS growth in history next year. And then we also have been seeing a trend leading up to earnings season where revisions for that quarter and the next quarter all come in lower and kind of trend lower. That's subsided, but a lot of that is basically just being dragged flat by the Magnificent Seven, who continue to outperform and drive the larger index higher. We think the breadth of that earnings revisions moving lower subsides at some point next year. And that could be around the same time where we see the first rate cut from the Fed, or expectations of a rate cut starting to be baked in, which would be a fairly Goldilocks type of scenario for the markets, and something that we're encouraged for and looking forward to going forward. The price to earnings ratio on the S&P 500 now sits at 17.1, a little bit lower than the historical averages, but still pretty high based on the economic backdrop, and not a ton of value in the overall market on the state side. Where we are seeing more value is here at home in Canada. Our index has done significantly worse than the US counterparts this year, which has made the valuation spread quite high. We'll talk about that on the next slide. But one of the big reasons has been this rapid increase in bond yields. It gets a lot of attention, really has been the driving force, even in the rally that we've seen so far this month, which has been quite a nice one to start November. Coincided with a pretty meaningful pullback in long-term bond yield. Particularly, you would have seen the US 10-year fall from about 5% to about 4.5%. That was a very welcome sign for bond proxies. So just to remember, as bond yields move up, bond prices move lower, and there's equities that act a lot like bond prices. You can think of things such as utility stocks, pipelines, telecommunication companies. All of these companies use a lot of debt in their business models to operate. So as debt prices moved, or the cost of debt moved higher, that kind of expectation from market participants like ourselves realized that they're going to need to refinance at significantly higher prices in the future, and that's not going to be great for earnings. And then the second aspect of all of that is a lot of those companies have very predictable long-term earning streams, and when you bring those earnings back to the present, it can be done at using a discount rate. That discount rate has gone higher. So all of that has led to a pretty challenging time. But what we're showing in this chart on the right is the price to earnings, including growth ratios for Canadian factors, has these dividend growing stocks doing quite well. We have a dividend growth Canadian dividend model that a lot of you are invested in. There, we're not looking for the highest dividend payers. Those often have a lot of issues. The reason their dividends are so high is because the price of the stock is probably moved lower versus the dividend moving higher. And so that scenario, stock price moving lower, probably coincides with some challenges for the company and could be eventually seen as a dividend cutter. And high dividend payer, that factor has done really poorly this year, and even worse with the dividend cutters. So we like to avoid those stocks. We pay very close attention to that structures in all the companies we're buying, their dividend payout policy, to make sure that they're not up against the wall and may have to cut the dividend soon. And then the health of the balance sheet, meaning how much debt to equity do they really have inside their business. All that is kind of a lead up to say, we're looking at deploying more cash from our models. So we run all of our investments through the InvestNet platform here at Canaccord, and for the bulk of the year have been holding elevated cash levels. We deployed a little bit back in May during the Silicon Valley banking crisis, and then a bit last month in October. And the conclusion of our investment committee meeting just this week was that it's probably a good time to set up, put a bit more cash to work. We're looking at leading indicators like risky assets like the NASDAQ and even Bitcoin moving substantially higher in the latest short order of time, coupled with the fact that we are moving into a seasonally strong time of the year and an election year where the government tends to be a little bit nicer to the stock market and the economy. So with all that said, we're kind of make the case for why we think Canadian dividend growing companies are attractive here. There's two parts to that. One was the valuation differential that we talked about. So Canadian equities are now trading at a 5.7 times discount to their US counterparts. This is one of the largest discounts in over 25 years. A price to earnings ratio is essentially the price someone will pay for your stock divided by the earnings you make, and in a lot of cases, forward earnings, what you'll make next year. And so that what people are willing to pay for US companies is a lot more than the Canadian companies. And so that's part of our thesis behind, moving into this value play. Another aspect is obviously we're talking about the intention of central banks to slow down the economy with the goal of slowing down inflation. We've said this many times before. The stock market isn't the economy. It tends to be a very forward-looking vehicle. You could think about 2022, very strong economic year, very weak year for the equity markets. And then that has kind of been a little benign here this year for Canada. The US market has rebounded nicely. And so part of that reason is where we are looking at repatriating some of those US dollars into loonies. The Canadian dollar has lost its petro currency kind of flavor lately. You can see that in the chart on the bottom right. And you can see a tight correlation with the price of oil, which has gone the other way here as the risk has been off in the market, meaning September and October were significantly weak months for the markets, and the loonie did not do so well. And so part of that, we think if we do get back onto a risk-on environment, meaning equities start moving higher again, we would expect to see the Canadian dollar rally. It's at 138 right now. It was 139 not too long ago, just a few days ago. So, again, kind of falling in suit with what we were expecting. And then lastly, Canadian dividends from a tax standpoint are much more preferential than the United States dividends, where there's dividend withholding tax. And so with all of that, that's kind of just setting up for some likely moves and hopefully breaking down, making some sense of the markets for all of our listeners on the call today.